All right, so welcome to chapter one. We are going to be focusing in on learning objective one today, that one of the forms of business and how accounting is used in business. That's our focus today. So let's say you wanted to start a business. You actually have three choices. There are basic forms of business, and three basic choices would be to be a sole proprietor, which basically you are the sole owner. And oftentimes sole proprietors um, are very, very small companies, very, very small, oftentimes employ just themselves or a couple of people. They're very, very simple to start in most cases. So if I was out with a bunch of friends and I said, what I really want to do is I'm gonna quit this teaching gig. I've been doing it for 26 years now. What I really want to do is, put a plow on my truck and shovel, plow snow and, do that type of thing. Well, could I do that? Yes, I could. There's nothing stopping me from doing that. So it's relatively simple to establish, and I can just start, announcing to people that I'm in business and I can plow their driveways and take care of the snow. Um, and boom, boom, I'm in business. I'm in business. It's a little bit tougher if I want to do things that require um, licensure or regulation. So I just cannot say I'm going to open a restaurant, for example, even though I might be a great cook, because there are health standards and other types of standards that I need to satisfy and get permits and permission before I can actually open up a restaurant. And so there's more to it on that side. I can't just decide to be, I'm going to be a barber. I'm going to start cutting hair. I can't do that because barbers are licensed trade. So I would not have a license to be able to practice as a barber. And so I can't set that up without first being a licensed barber. So again, some trades, for example, are regulated by the state. You need a license before you can actually get things done and start a business. But for the most part, businesses can be relatively straightforward and easy to start for most people. If I wanted just to clean houses, I could do that. I can start today, in fact. And so, no problem. But other businesses that I want to start might be a little bit more entailed. But one thing I can do for sure is simply be my own boss and work for myself and have a business that I own solely, and that's a sole proprietorship. Okay. But let's say I wanted to, bring in my partner, my cousin, whatever, as a business partner. Um, well, when you have a partnership as a form of business, that's two or more people that are establishing a business. And I like to emphasize on the or more, two or more. So a lot of people look at a partnership and just say it's two. No, actually, I mean, yes, two can be a partnership, but so can three, and so can 23, and so can 123. So partnerships can be relatively basic and small, can be quite huge. And there's partners that are active in running the business, and there are partners that are basically just investors. So there's a difference between what we call a general partner, who's the active partner, and a limited partner, who is basically an owner because they put an investment in, but they don't really do any work for the company. And so partnerships can be quite complex. It's best to actually make sure you understand the complexities and have an agreement with your partners. Um, but they are, generally speaking, simple to establish in most cases. Certainly, with a partnership, you have two or more people, so you have a lot more skill, a lot more resources for the business to be successful than doing it all on your own. And so there are some benefits there. But of course, partnerships are complex because partners can bind each other to agreements as part of the business that other partners might not want to do. That can cause conflict. If you're not careful in discussing what's your part, what's my part, and how we're going to be making decisions, that can cause conflict. And so partnerships, like a lot of other relationships, don't always last very long, um, unless there's a commitment to working through those particular problems. Notice the sole proprietor and the partnership both have something called tax advantages as listed in your book. Well, what they mean by that is if you are a sole proprietor or if you're a partner, under the law, there is no distinguishing you, the person, from you, the business. You are one and the same. Okay. And that creates advantages like being taxed as a person. And tax rates for people start at 10% and go up, right? But the opposite or disadvantage of that is if you are sued because of something your business did wrong, well, you are sued. It's not just your business is sued. You, the whole person, is sued because, again, under the law, there's no distinguishing between you, the person, and you, the business. So when something goes wrong, it goes wrong for you. And that's a drawback of sole proprietorships and partnerships is yes, you get the tax advantages, which is terrific, but you also have this enormous amount of liability that you can be held for. One way to deal with that is to change your form of business to a corporation. Corporations are basically legally recognized individuals by law. So they're entities, not really individuals. So if I go from Mike, the snow plower, as a sole proprietor, I can also be Mike, the snowplower incorporated. I can be a corporation. I can incorporate my business. And what happens when I incorporate the business is now Mike Arujo, the person, is separate from Mike Arujo, the business corporation. And so if something happens with my business and I get sued, my business gets sued and everything that the business owns is at risk. But my personal stuff is not. Okay, my personal stuff is not. And so the corporation allows you to have a legal separate entity, which is really, really important to do. Corporations are are not necessarily a popular form of business, but they are the largest form. Most of the companies that you and I know are familiar with are corporations. But in terms of actual numbers, sole proprietors are common. That's the most common form of business, but they're small, so you don't really hear about them often. Corporations are large, are very, very large, and so you get to know them a bit more. So corporations are easier to raise funds because corporations are owned by stockholders, whereas sole proprietors are owned by an individual, partnerships are owned by two or more individuals. Corporations are owned by stockholders or shareholders. They mean the same. And so that's also a difference. Those shareholders or stockholders are the owners. And you can have a number of different shares of ownership in a corporation. And so that's something we'll learn in more detail as we go through the course. But basically speaking, this is a very, very common way of organizing for sure, particularly if you want some protection against personal liability, which sole proprietors and partnerships are that's a disadvantage for them. Okay, there's a bunch of hybrids out there. You probably have heard of LLCs and LLPs and so forth. It's just a hybrid form. It has the benefits of the corporation and the benefits of a partnership sort of melded together. And that's basically what some of those new fangled hybrids are. Okay. So you have a choice, and there's certainly advantages and disadvantages to all those choices when you want to start a business. Businesses, of course, run on and need to keep financial information. So when you look at financial information, who uses financial information and how do they use it? This book looks at life from the corporate form. Okay, what we're going to be learning about is corporations in this course. So when you look at a corporation and you see inside users, internal users, people who are working for the corporation, right? Who uses financial information? Well, every department uses it. Management uses it to make decisions. Marketing uses it to help with prices. Obviously, the finance and accounting department uses it in a number of different ways. Human resources uses it because they have, to hire employees and they need the financial information, et cetera. But financial information is critically important to the users inside a corporation. Okay. The wonderful thing about corporations is all their financial information, if they're what we call a public corporation, their financial information is actually available to you and I as external users. But external users mean investors are interested in learning more about the financial status of a particular corporation, like Tesla, like Apple, like Microsoft, um, like Netflix. Uh, so investors will use financial information that's provided to make sure, is it profitable? Is it worth investing in this particular company? In other words, should I be a stockholder? Should I be an owner in this company? Of course, creditors, and the word creditor is lender. Okay, so anyone who's a creditor is a lender. Creditors want to know about the financial information of the company because they want to make sure that if they lend you money, they're going to get it back with interest. That's their business, right? They're not interested in losing money, giving you a loan and not getting repaid. That's not their business model. So creditors basically want to know about the financial information so they can make decisions that are good for their business. Okay, so there are external users, people outside of the company that use financial information, as well as people inside the company. Okay. Chapter 1, Learning Objective 1, also talks a little bit about ethics in how financial information is reported by corporations. This is a tough one because I cannot teach you ethics. You all know right from wrong. All these people know right from wrong. It's not like it's a new thing. We're all taught a certain level of right and wrong from the times that we're able to talk as a young child, all the way up to whatever age you are now. The weird thing is that in a business setting, the pressure of making money, because that's the reason you're in business, sometimes overwhelms people's judgments of what the right thing to do is. And this has happened in every decade that the country has been in existence, and we've had the rise of the large corporations with the robber barons in the 1870s, 1880s, all the way till today. When you have a corporation that anyone can be an investor in, that's a public corporation. You and I can be an investor in any company that we see on the stock market. It's important that that information be accurate so we can make good decisions as investors. And what happens is some companies have disclosed bad information. And so companies that are listed here, like Enron, like WorldCom, like Health South, et cetera, they basically gave false information they lied, in essence, to the public and to their own stockholders about the condition of the company. And of course, you know by now, Enron doesn't exist anymore. WorldCom doesn't exist anymore. Um, and when there's a when you know you can't base an existence on lying, and that's fraud. And basically, the whole company goes under when those things happen. Thankfully, some companies have been able to get saved. Health South still is in business. AIG is still in business, although they're different than they used to be. They're smaller because of all these financial scandals that happened many years ago. Um, because financial information is the basis of our capital system, the stock market, the bond market, any way companies raise money to do productive purposes in the capitalist system. We as investors, whether we're investors in the stock market or in the bond market, we want to make sure that the financial information is accurate so we can make good decisions as investors. And so there's been a lot of pressure on regulators and lawmakers in Congress to make sure that there are stiff penalties for companies who lie about financial information to investors and to others. And so Congress, way back when George W. Bush was president, we're talking about at this point, I think it's 2001, 2002, in that area, Congress passed a law called Sarbanes-Oxley. We call it SOX. Um, and basically speaking, for the very first time under law, um, presidents and CEOs of companies, uh, certain members of the board of directors of a corporation could actually go to jail for lying about financial information deliberately, right? To deceive and commit a fraud. And so that changed a lot. That doesn't stop fraud from happening, but at least there's punishment now. Prior to that, there really wasn't much of any punishment involved in committing a fraud. There were more laws in place, but there weren't great amount of punishment in place. So that did a lot. That did a lot. I'm not going to go over an ethical dilemma with you. I think, again, I'm not going to be teaching you ethics. I'm just going to show you that there are very good people um, that run businesses, that they might be very ethical people, but sometimes under a certain amount of pressure, their, whatever moral compass they had sort of goes away and they do the wrong thing. Um, and that's a sad moment, but at least there are laws in place now that will punish that if investors are hurt. So investors were hurt when there's misinformation that drives the stock price up that's based on false information. Um, Investors are hurt when companies don't disclose their real financial condition and they look stronger than they are only to collapse down the road. So anytime investors are hurt, that's what these laws are there to protect. At the end of every learning objective, there are do it exercises that are in your book and here in the slideshow that actually give you an example of a question and, wonderfully enough, give you the solution. Okay. So this particular question looks at organizational characteristics and can you identify the form or forms of business in which they're associated? So, number one, which form of business makes it easier to raise money? Well, corporations, because they simply can have more and more shareholders over time. And thus, shareholders are meant to raise money. You put money into a business and you get shares of ownership in that business. That's basically the deal. Okay. So, and it's so much easier to do that. You can't do that with a sole proprietorship because there's only one owner. And that owner doesn't want to give away any ownership, right? Um, Partnerships can take on new partners. Yes, that's true, but then new businesses start every time a partner is added or deleted. You technically have to keep separate records for that. So it's a pain in the backside. Corporations are unique in that sense, and so it's easy to raise money. Forms of business that are simple to establish, the simplest for sure, sole proprietorship. Partnerships can be very simple as well. It depends. I think there should be a lot more work that's done in partnerships that there are, but it is and can be simple to establish. There's no personal legal liability as a corporation because when you create a corporation, you are creating a separate identity under the law, separate from you personally. That doesn't happen with a sole proprietor or a partnership. There's no distinguishing between you, the person, and you, the business, as a sole proprietor or a partnership. So there's more risk in it for you personally. Corporations take that risk away. So that means there's less legal liability in a corporation. It doesn't mean the owners can't lose anything, but they're limited. The most they can lose is the investment in the company. That's it. They can't lose any of their personal assets, but you can as a sole proprietor or a partnership. Tax advantages, well, sole proprietors put their profit on their personal tax returns. Partners put the profit of the company on their personal tax returns. Personal tax returns simply start at lower tax rates. They start at 10% and go up from there. The corporate tax rate is 21% and goes up from there. So it's a much lower tax rate to tax your profits. So that's the tax advantage there. And in terms of ownership transfer, if I owned a barbershop and I sold it to someone else, it's no longer my barbershop. It's that other person's barbershop. And that other person's barbershop can have all different types of things that they want to do because they're the new owner. Every time you transfer ownership in a sole proprietorship or a partnership, everything changes in the business. That's not true with a corporation. In a corporation, the ownership of the business, which is the stockholders, and the management of the company is separate. Okay. So just because I'm a stockholder in McDonald's doesn't mean that when I go to McDonald's and they get my order wrong, I can say, hey, I'm an owner. Who did this? You're fired. Right? I can't do that. Because as an owner, I'm limited in a corporation. I don't have that power. Certainly, if I'm a sole proprietor, I'm a partner, yeah, I have that power to do that. But an owner of a corporation is separate from the management of the corporation. And so it makes it easy to transfer ownership without interfering with how the company is working. So here's an example. It is 10:20, roughly. The stock market's been open for almost an hour. There probably has been millions and millions of shares of ownership exchanged in lots of companies. Maybe it is McDonald's, maybe it's Walmart, maybe it's Walt Disney, maybe it's another company. But lo and behold, nothing has changed at the Disney store or the Disney parks that are still open, or the Disney hotels or other types of things. Nothing has changed at the McDonald's. Nothing has changed at Walmart. Because the ownership has changed doesn't mean the company has changed. That's solely unique to the corporation. Okay, the corporate form. If I sold my ownership as a sole proprietorship or as a partnership, everything has changed because of those new owners. They want to do things differently. They have those powers. So certainly it's one of those very interesting forms of business that has its own advantages for sure.